Welcome to Chapter 3, Lecture Series, Part 5. We're still explaining adjusting entries, and this part is about accrued expenses. An accrued expense is defined as a cost incurred in the current period that is both unpaid and unrecorded. When you use your credit card, you often do not record the transaction until you pay your monthly invoice, even though you incurred the cost. Accrued expenses must be reported on the income statement in the period when they happened. For all accrued expense adjusting entries, we debit or increase an expense account and credit or increase a liability account. Accrued salaries expense. Fast Forward pays its employees $70 per day or $350 for 5 days work. The salaries are paid every 2 weeks for 10 days on a Friday. It's December 31st. It's a Wednesday. So there are 3 days salaries are owed at the end of the year. $70 times 3 is $210. Adjusting entry increases the liability salaries payable and increases salaries expense account with the 210 with this entry. We debit salaries expense for 210. And I will tell you this, when we are doing adjustments, unless you're fixing something, you're fixing an error, expense should always be the debit. Then we're going to credit salaries payable, the 210, and this will record the salaries that happened in December that are going to be paid at a later date. After the adjustment, salaries payable account will show the correct balance of 210, salaries owed, and salaries expense account will report the correct amount of salaries expense on the income statement. Here I have the 210 for my salaries payable balance, and salaries expense is now a total of $1,610 that is due to employees. After the adjustment, the salaries payable account will show the correct balance of 210 of salaries owed on the balance sheet, and salaries expense account will record the correct amount of salaries expense on the income statement. Future payment of accrued expense. Fast Forward has accrued salaries of $210. On January 9th, the first payday in the next period, the following entry settles the accrued liability, the salaries payable, and records salaries expense for 7 days of work in January. The $210, that's the $3 times the 70, reflects the payment of the liability for 3 days' salary accrued on December 31st. The $490, 7 times the 70, records the salary for January's first 7 working days. Notice the date on this is January 9th, including the New Year's holiday, as an expense of the new accounting period. $700 credit records the amount of cash paid to the employee. This is the cash that went out for the payroll. Salaries payable. At the year end, salaries expense of $5,000 has been incurred by the company but not yet paid to their employees. What is the current account balance? So salaries payable. In the next one, we have to determine the current account balance should equal, and then we're going to record adjusting entry. Now remember, the income statement, the debit is an expense. The balance sheet, we credit a liability. As of December 31st, we have a $5,000 balance. So the current balance was 0. The count should be 5,000. The difference is the adjusting entry. To record that adjusting entry to get from step 1, remember they were talking from step 1 to step 2? Step 1 is what we had before this event. Step 2 is what we should have after we create the journal entry. We're going to debit salaries expense for $5,000. Credit salaries payable for $5,000. That will create our adjustment and give us the balance we were looking for in our salary payables account. Every adjusting entry affects one income statement account, a revenue or expense, and one balance sheet account, an asset or a liability. In this case, we need to credit the liability account, salaries payable for the $5,000. Since we're crediting the balance sheet, we need to debit the income statement. We debit salaries expense. Remember, no cash is on an adjusting entry. If there's cash out there that wasn't recorded, that should have been a regular entry, a daily entry, not an adjusting entry. Interest payable. On December 31st year end, the company holds a mortgage payable that has incurred $1,000 of annual interest that is neither recorded nor paid. The company intends to pay the interest on the 3rd of January of next year. We first have to determine what current account balance equals. We happen to have zero in the account now. We have made no interest payable entries that haven't been removed or paid off. The next thing is to determine what is the current account balance should equal. They're telling us we incurred $1,000. So our balance on December 31st in this interest payable account should be $1,000. But we've got to get the money in there. And we're going to do that with the adjusting entry. I will debit interest expense for $1,000, credit interest payable. Now this interest payable has that $1,000 adjustment, and that justifies my balance that I expected of $1,000. This is the end of this part. I hope these short ones are working for you so that way you can readily go back to them and see what you need.